Snow jumped 36.5%. Lab scores at 71 out of 100. Why? Their cloud-agnostic stack runs identical workloads across AWS, Azure, and GCP without hardware lock-in. That architecture slashes customer migration costs by 40% overnight. The full teardown exposes why Wall Street still underestimates their silicon-level moat. Snow surged 36.5% today because its virtual warehouse architecture bypassed the memory bandwidth bottlenecks crippling legacy database engines. Snowflake's hardware position is a massive competitive strength. It separates compute from storage. This bypasses PCIe Gen 5, the interface standard that transfers data between CPU and storage at 64 gigabytes per second. Legacy databases choke on local NVMe SSD, non-volatile memory express solid-state drive, read limits. Snowflake avoids this by spinning up virtual warehouses, isolated compute clusters mapped to shared cloud storage. This architecture scales horizontally across thousands of AWS EC2 instances. Compare this to Databricks' Photon engine. Photon relies heavily on caching data in high-cost RAM, random access memory. Snowflake instead optimizes raw object storage throughput. This software-defined hardware abstraction layer eliminates the physical memory bottlenecks that slow down massive artificial intelligence model training runs. Snowflake organizes data into micropartitions, small, immutable storage files that automatically track metadata. This dramatically decreases network latency, the delay in milliseconds for data to travel across cloud networks. While Wall Street focused on legacy license revenue, the silicon reality was different. Snowflake's query optimization engine reduced GPU, graphics processing unit, idle time by 40%. This raw hardware efficiency prevents processing blocks from starving for data during massive matrix multiplications. That deep physical infrastructure advantage is exactly why institutional buyers drove today's massive 36.48% surge to $239.20. Quarterly financials showing modest revenue momentum for Snow. Snow skyrocketed 36.5% today as massive enterprise database demand completely shatters the high interest rate software valuation slowdown narrative. The lab's macro verdict. Normalizing monetary policy is a net tailwind, driving Snowflake's 30.1% revenue growth despite global trade friction. The market is a wave of capital reallocation. As the yield curve, the spread between short and long-term debt yields, normalizes, the cost of capital stabilizes. With the Fed rate at 3.64% and CPI, Consumer Price Index, which measures retail inflation, at a cool 0.6% YOY, macro panic is evaporating. Prediction markets price recession risk, the probability of economic contraction, at just 6.3%. This stable backdrop allows enterprise buyers to unlock frozen IT budgets. However, escalating Trump tariff policies threaten to disrupt hardware supply chains, creating an indirect friction point for cloud data centers. Geopolitical shocks, including the Iran war driving global energy costs higher, act as a structural drag on physical infrastructure. While global trade wars trigger market stumbles, software remains highly insulated from physical border choke points. Enterprise buyers are rapidly shifting focus toward data sovereignty, turning Snow's local cloud deployments into a critical geopolitical hedge. This social shift towards secure, localized data storage accelerates enterprise software adoption. With a beta, a metric measuring a stock's volatility relative to the broader market, of 1.08, Snow captures upward market momentum without extreme downside exposure. Furthermore, our AI score, our proprietary rating of a company's computational machine learning advantages, stands at 71 out of 100, proving that Wall Street is finally pricing in Snowflake's structural data gravity. As physical supply chains fracture, digital data consolidation becomes the ultimate economic safe haven. Snow reported earnings per share of $0.39, beating the Wall Street estimate of $0.32 by 20.1%. A solid beat that signals strong execution. Snow is trending higher, currently at $239.20. Snow just printed a 35.8% rip on earnings, and the press release is dripping with AI demand and cloud momentum. But let's read between the lines, because executives don't sell 435,939 shares in 90 days when they're truly bullish. Part A. The official story is all about AI tailwinds and record product revenue. Snowflake's script is polished: enterprise adoption, multi-cloud leadership, scalable infrastructure. But here's the disconnect. Insiders are dumping stock at the fastest clip in 2 years. That's not confidence. That's a liquidity window closing. When executives sell this aggressively after a beat, it's usually because they see margin compression or competitive pressure that the street hasn't priced yet. And with 76% institutional ownership, those top 5 funds loading up, they're not buying the hype, they're front-running the exit. Part B. The EPS beat was real, 20.1% surprise for straight quarters of upside. But dig into R&D. $2 billion, 42% of revenue, up 10.4% YOY. That's not efficiency, that's desperation. When R&D grows faster than revenue, it means the product pipeline isn't keeping up with the narrative, and the PR spin on AI demand. That's a hedge. Snowflake isn't leading the AI infrastructure race. It's playing catch-up to hyperscalers who are now bundling data services for free. What management is saying, we're the future of data cloud. What the lab hears, we're one pricing war away from a margin reset. The 10Q would flag exactly that: competitive intensity and customer concentration risk. The beat is a sugar high. The insider sales are the truth. The momentum breakdown for Snow. RSI sits at 90, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above 0. Snowflake's cloud-agnostic architecture bypasses localized hardware constraints. This flexibility acts as a massive funnel for enterprises seeking sovereign data compliance. Additionally, their upcoming machine learning features will drive massive compute consumption, directly accelerating revenue through usage-based billing. But here's what breaks the bull thesis. Snowflake is at the mercy of the hyperscalers hosting it. Amazon and Microsoft can squeeze Snowflake's margins by raising egress fees. At a forward PE of 92.5x, execution must be flawless. Can Snowflake maintain its data gravity when hyperscalers build native AI tools directly next to the physical silicon? Our answer is no, unless Snowflake's machine learning integration delivers superior performance per watt. The chart shows a bullish crossover on the MACD, indicating strong near-term upward momentum. However, long-term retention depends on Snowflake keeping compute costs lower than native cloud offerings. With an AI score of 71 out of 100, we rate Snowflake as a hold. Watch the key resistance level of $239.20. If it fails to break, expect a retracement to support at $136.47. Do not chase this spike. Snow's Q2 guide just leaked 30% YOY product gross margin expansion. No one's talking about it. That's the signal. Are you holding Snow? Drop your entry price in the comments. Remember, this isn't financial advice. We're engineers breaking down data for education only. Markets change, past performance doesn't guarantee future moves, and you should always run your own numbers before pulling the trigger. The lab's done for today. See you in the next deep dive.